Good morning and welcome to this Wednesday, March 18th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. It is going to be another rough day, at least getting started. We've seen a lot of these gap downs, and I saw a couple of different articles pointing out that the last 7 days we have seen at least a 4% move in one direction or the other on the S&P 500. That's the first time we have seen that. The previous record was 6 times. So it's the first time we've seen that since 1929. And that was not a good year. So all this volatility and all this fear certainly is not good for the market. And we're seeing it in terms of these huge moves back and forth. Before we get started, I do want to mention that we had a webinar yesterday after the close on Max Pain, and the webinar is still processing, so it's kind of out of our hands, so it hasn't been updated on our website, but as soon as it is completed, it's processing, we will have that posted on our website. Also, if you're a subscriber to our free Earnings Beats Digest newsletter, there was a technical glitch this morning, so we will be sending that out tomorrow morning. So this week will be Monday, Thursday, Friday instead of Monday, Wednesday, Friday. So I want to take care of a couple of things there. But let's take a look at what happened yesterday, because this has really been the tale of two markets. The way we finish one day and the way we open the next day seems to be polar opposites, and it's happening again. Yesterday, we saw the Dow Jones Industrial Average. We'll go through these numbers pretty quickly, but the Dow was up 1,000 points, 5%. The S&P 500 was up 6%. 143 points back above 2,500. The NASDAQ up 6%, 430 points back above that 7,000 level, above 7,300. Mid caps underperformed on a relative basis. Small caps actually had the best day. It's been a long time since I've said that. But small caps on a percentage basis actually outperformed all of the other indices, gaining almost 6.5% yesterday, rising 40 points to 670 on that index. As far as the individual sectors go, as you can see down here at the bottom, utilities and consumer staples, two defensive groups leading the rally. Not ever a good sign, in my opinion. I like to see the market having a risk for appetite when we go higher. Definitely did not see that yesterday, although you do see the technology. One of the 5 main aggressive sectors that I look at, it's the only one that was in the top 5 yesterday. So even though we went higher, the market, the dispersion of the money going into the market was not great. It wasn't good. I shouldn't even say it wasn't great. It wasn't good. We want to see more risk being taken when the market is going to the upside. We didn't see that yesterday. Healthcare up 6%. You can see utilities, by the way, up 13% yesterday. That was a huge move. And consumer staples, 8.5%. Technology almost 7%. Healthcare roughly 6.25%. And then materials a little over 6%. So those were all of the best performing groups, but you can see still all of them in a downtrend. So not really what I would consider great action on the day yesterday. And as far as all of the sectors go yesterday, energy was up, but only about 0.75%, a little less than that. Consumer discretionary, we saw consumer staples up 8%. Consumer discretionary up less than 4%. So consumer stocks were doing better yesterday, but they were clearly doing better in the more defensive staples area. And again, that's not a great thing when you look at the market. Now, for those of you who haven't seen, I just want to pull up this spreadsheet, because it really, for me, it still remains somewhat of a head scratcher. I've looked at the spider quite a bit, but I'm going to pull this up. This is the QQQ. And starting back on February 21st, this is just an Excel spreadsheet tracking the opens and the closes each day to determine how much opening gap we have in whether it's higher or lower, and then what happens the balance of the day. And so from February 21st through yesterday's close, the QQQ had dropped $48 from 230.27 down to 182.14. Of those $48, $53 came on the open to the downside. So more than 100% of the drop came at the open. Whereas during the trading day, if you just weren't in the market, if you just said, all right, I'm just going to get in 9:30, I'm going to exit at 4 o'clock. If you had done that since February 21st, the last month, while the market's been getting crushed, and you had done that with a starting portfolio of, say, $100,000, all you did was exit at 4 p.m., enter at 9:30. Your $100,000 would be worth $103,000 right now. And I find that to be absolutely fascinating. Not that I did it, unfortunately. Not that I suggested anybody do it, unfortunately. But that's the way the market has operated. It's operating a lot on fear. And I understand, we're getting announcements during the day. That's accounting for some of this too. I mean, we're constantly getting backstops from the government, the Fed. And by the way, the Fed canceled their meeting that was scheduled because of their emergency actions over the weekend. They have canceled their meeting. So we're not going to get an announcement from the Fed today. I just want to make sure everyone knows that. But still, when you look at this, and I look at the spreadsheet and I just think about, normally what happens in a bear market is everyone, well, not everyone, but folks who want to get out are able to get out in the early stages. But this has happened so quickly. And like I said, on the open for the most part, that I don't know how big money, if they want out, is able to get out with the number of shares they're trying to get out. So I don't know. The whole thing here seems very odd, and I really don't know the answer. I just feel like it's noteworthy and worth pointing out. And we're seeing it again this morning. We got the futures right now. The futures are lock limit down, but you can still pull up the ETFs. They do not trigger any kind of a lock. And so right now, the SPDR this morning is down 6%. So everything, we gained 5.4% yesterday during the day, primarily. Not all of it, some of it. But we're down 6.12% right now as we're, 25 minutes from today's open. Anyhow, I thought that the spreadsheet's interesting, and I just want to show it. I've showed it a few times, but for those of you who maybe haven't seen it, I thought it was good to show. All right, let's get back to the charts. 10-year Treasury yield today. So we've got the housing starts out today, and this was one I wanted to watch because it's February, but we got housing starts and building permits, and I just wondered how much impact, because the housing stocks have been absolutely pummeled. And, I don't know if there's, maybe the market just can't see any end in sight. That is a big part of the problem right now with the market is we know things are going to be bad, but we don't know how bad, and we don't know when it's going to end. And when the market can't figure something out, when you get this kind of uncertainty, Wall Street absolutely loathes as in hates uncertainty. And that's all we have right now. I mean, there's just nothing concrete that we can say, okay, this, is going to end in June, or it's going to end in September, and things are going to start to return to normal. People getting, those who get laid off going to get their jobs back. We don't know any of this. So it's the constant fear of the unknown, and then also the constant media attention. And I continue to say this. I mean, I think when we look back at all the previous big drops and scares that we've had in terms of Wall Street, and financial scares and just people worried about, their jobs and things like that. Almost every significant one has occurred prior to really there being much in the way of social media, number one. And also, when we look back to 2008, yeah, we were all on the internet, most of us on the internet at that point, but it still wasn't like it is today. I just know today it's like just, second nature. You pull it up on your phone, you pull it up on your computer, wherever you are, you got the internet. And a lot of that has changed over the last 10, 12 years. And so I think the access to media is a lot different. And it doesn't seem to matter now what you do, where you go, you can't get away from the news. And I think that is a lot different than what we've had in the past. So I think it's a combination of truly impactful economic, fundamental economic deterioration as a result of the coronavirus. But then there's an element of fear that is unprecedented, in my opinion. I mean, it's unprecedented based on what we've seen in the VIX. It's unprecedented based on what we've seen in the equity-only put-call ratio. And I just truly believe it's unprecedented. Even if I wasn't seeing it on the charts, I would think it was unprecedented. So all of that is leading to a lot of fear, a lot of panic, and a lot of irrational decisions and trading and so forth. And unfortunately, I don't see a short-term end to that. I wish it would just go away, but I don't see it ending. Now here on this chart, and I'm going to give you a quick update here. This is a long-term chart on the 10-year Treasury yield. When I say long-term, it's 3 years. But when you go back the last few years, you can see that the moves to the downside, and this is a daily chart, by the way, but the moves that normally, when we get the moves to the downside, we have corresponding, or even moves to the upside. Normally, we have corresponding moves in the S&P 500. And that's what this correlation at the bottom is telling us, that the correlation between the 10-year Treasury yield and the S&P 500, it's not perfect. It's not, when the 10-year Treasury yield goes up, the market goes up, or when the 10-year Treasury yield goes down, the market goes down. It's not a perfect correlation, and that's why you see a lot of the gyration here. But you can see that a lot more time is spent up here from 0.75 to 1, which is very strong positive correlation. You can see we get up there quite often. Down at the bottom, minus 0.75 to minus 1, you're hardly ever there. So there's no doubt that there's a correlation here, but it does fluctuate back and forth. What I'm finding interesting right now is we are, I was really hoping and wanting from a stock market perspective to see money coming out of the Treasury market and sending the yields back up because we were having the yields melt down. Well, we're getting that, but the money that's coming out of Treasuries is not going into the stock market. I'm not sure where it's going, but it's not going into the stock market. It's probably just sitting in cash because of all the fear, because of all the uncertainty. I think that is a positive down the road at some point, because at some point the cash is going to make its way back in. And probably as we begin to see the light, that's when we'll start to see that more and more. So I do think that this is maybe a longer term positive, but short term, the movement back up in the 10-year Treasury yield is not having the kind of impact on the stock market that I would have liked to have seen. Let's talk a little bit, talking technically here, about the dollar, because with that sudden surge, I'm going to go back and look at the 10-year Treasury yield again. You can see here in March, just over, probably since the first week of March, we've had this huge move back up from, I don't know what the low was. I think the low close was around 0.4% on the 10-year Treasury. Now we're back up to 1.12. So this has been a pretty big move to the upside in the Treasury yields. That kind of movement, strengthening yield, normally strengthens the dollar. And you can see the dollar, after a huge move down, following the Treasury yields down into the first week of March, we're now seeing the dollar rebound very, very strongly. And the impact that this is having on commodities is, commodities were already weak. And they were weak not because of the dollar, but they were weak because of demand. Global demand has been going lower, and it's forecast to continue to go lower. So most economists now at this point are looking for a global recession. Most economists are beginning to talk about a U.S. recession, and maybe even a deep recession for a quarter or two, a couple quarters. I guess you have to have 2 quarters for a recession. But you can see the reaction from the dollar is sending the commodity prices lower. This is the CRB index. It was already going down, and I think a lot of that had to do with an anticipation of global economic weakness. But when we really broke down was when we started to see this coronavirus turn into a pandemic. And so we've had the big move down in commodity prices. Even gold, which is usually a kind of a safe haven when things get really fearful, and it was up near a high. But with the dollar surging, even gold took a little bit of a hit. You look down at silver, look at the big drop in silver, and had a member write to me and ask about copper, wanted me to talk about copper. I think copper is just falling in line with everything else in the commodity area. With the dollar all of a sudden surging, and with economic demand, global economic demand weakening and expected to weaken further, I would expect that your commodity prices are going to be under pressure. And I would continue to look for energy as long as crude oil prices keep dropping. I got a chart on crude oil right here. This is going back 2 decades, weekly chart on crude. And you can see we were at 65 to start the year per barrel. We're at 26, and this doesn't include today's action. And I believe today we are down to 25. 24.28, down another 10% crude oil prices today. 24. So we're now down under $25, which is a 17-year low in crude oil prices. And it's a combination of a lot of things. We've got the price war battle. We're not really doing anything to address supply concerns. If you got too much supply and all of a sudden plummeting demand and a rising dollar, it's a perfect storm for crude oil prices moving lower. So we've got all of that funneling in. So there's a lot of things coming together here that are obviously driving the fear in the market. And until we can begin to get a handle on it, and I think it all starts with topping out these cases on the coronavirus. I think until the growth in these cases begins to slow, I think it's going to be really difficult for the market to begin to assess the damage that it's caused and that it's going to cause. So I really believe this next month is going to be critical for the market. I would have said there's no way that the VIX, after hitting 83 on Monday, I guess it was, that we were going to see, the VIX continuing to move up. But we don't see an end right now in sight of the coronavirus and the impact that could have. So maybe, this is obviously going to set a new precedent in terms of fear. And so maybe we need to see the VIX hit 100. I don't know. I don't think anybody can predict that. But it is important to note that this is a lot of this move to the downside, while it is impactful, economically impactful, the coronavirus and the supply of oil and all these oil prices moving down, all of this, it's all impactful, but it's also being heavily distorted by all the fear. All right, let's take a look. I want to go over some relative strength with you. And I'm just going to go through the sectors really quickly so you can get a sense of which area of the market. Now, keep in mind, the S&P is going down. Every area of the market's going down. So relative strength is just telling us if a group is going up higher relative to the S&P, it just means that it's not going down as much as the S&P. So more and more of the money that's rotating, out of the market, more and more of it's coming from areas that are underperforming the S&P. So technology pulled back a little bit yesterday, but overall, it has been on a move higher. Here's where you can see consumer discretionary, and this group has really fallen apart. And there are areas, even when the market bounces, that we just don't see a bounce in consumer discretionary, or at least areas. I was looking at some of the restaurant stocks yesterday, and, with many states now saying, hey, we got to shut down restaurants and bars, how are those stocks going to go higher if they have to close their doors? Even some that are staying open, those are ones generally have drive-through. So you got McDonald's, Starbucks, things like that. I go in, my whole personal schedule has been disrupted because I used to go into Starbucks every morning and write. And the Starbucks I go to is still open. I went in there yesterday and I went inside the store and got my drink and then walked out. But while I was in there, I was asking them about their traffic and their business. And they just kind of said there's hardly anybody here. So even the drive-through, even though they're open for the drive-through, people are just, I think it's a combination of things. Number one, they don't want to go out if they don't have to. And number two, when people start becoming fearful economically, they don't want to spend money. So you got that plus the closures, areas like restaurants having very difficult time. So, you can see the impact on these charts of areas of the market that are getting hit the hardest. And it's very important to pay attention to those until, we start to see the light at the end of the tunnel. Areas that are getting hit really hard are probably areas I would continue to avoid. I know they may seem tempting. And I think short term, we had a Max Payne webinar last night. And even though, futures are down, I wouldn't be surprised if we have some huge volatility heading into Friday because of options expiration, maybe even into the early part of next week. But outside of short-term trades, I think longer term, looking at a month, I don't know that there's enough clarity. I don't think there's any clarity on how far these stocks could drop and what the government response is going to be in various industry groups. So I think you have to be careful, and I think that's what's going on. That's what the market is telling us. Communication services. This is just kind of going along for the ride. Not really a lot of up, not a lot of down in terms of relative strength. We've seen a couple big moves, but for the most part, it's just going for the ride to the downside. And again, this is how you can see It's going down. Don't let this confusion think, wow, this is a great group. It's going down a lot, but it's going down basically the same rate as the S&P. Industrials, you can see getting hit very, very hard. Groups like airlines, any kind of travel, getting hit hard. Financials, with the plummeting yields, banks were getting hit hard. Life insurance, asset managers, investment services, those areas getting hit. So financials taking a huge drop. Healthcare, as you might expect with a health scare, healthcare stocks are doing very well on a relative basis. They're still going down, but there are actually pockets of areas in healthcare that are not doing too badly. And individual stocks, especially if they're working on anything having to do with the coronavirus, some individual stocks are continuing to hold up pretty well. Consumer staples on a relative basis. You got your food stocks. Try to go to a grocery store right now. Their sales are going to be through the roof because everybody not only is getting enough supplies for this week, but they're getting enough supplies for the next 6 years. And as a result, many of these grocery stores are having problems just keeping their shelves stocked. Real estate was doing okay, started to pull back here recently on a relative basis. But again, still on an absolute basis, you can see the damage that's being done everywhere. Utilities breaking out to the upside, defensive group makes sense, but also getting hit to the downside, just not as much. Energy, just been horrible. It's been horrible for a long, long time. This is just adding to what already was just an awful picture. All right, so anyway, I wanted to kind of go through those and just point out the relative strength of the various sectors so you can kind of get a sense visually of where the market is favoring. If you're an ETF trader and you might, want to stay invested, but you want to know at least where the areas are that are being most impacted to the downside. Hopefully that gives you a little bit more information. All right, let's see, what else do we have for today? Let's go ahead and talk about earnings a little bit. There's not really a lot of earnings out. FedEx did come out with their earnings report, so let's go ahead and pull that up. Go to a relative chart. All right, so FedEx reported they did miss $1.41 versus $1.49. Stock was already down, but of course so is the overall market. They withdrew guidance. So that was not good, but it's also something that's happening more and more frequently. And that's what I was speaking about at the very beginning. I mean, it's just hard to tell folks what you're going to earn when you don't know what the economy is going to look like. And you don't know when we're going to get the coronavirus under control. You don't know when people are going to be able, to kind of move about a little bit more freely without worrying about that as much. And so all of that just, you combine that with everything else that's going on, you really just don't know what to tell folks. And so it gets back to the uncertainty that's driving the market right now. On a relative basis, though, you can see that FedEx relative to its peers had started to outperform, but then just recently, the last few weeks, had gone down before today's action. Now I'm going to go over here and I'm going to just give you a quick update on where FedEx is trading. It's only down 3%, which is actually better than the overall market, unless the market has done something different. No, still S&P Spider down 6%. So FedEx, even missing, withdrawing guidance, is actually doing better than the S&P, though it's down. Let's do a couple of others. There was MDB. This is a smaller software company. And the stock had gone down to previous lows, actually rallied back nicely yesterday, 15% prior to earnings. And one of the things I wanted to point out here on this chart, what I've seen, and this gets back to the spreadsheet that I showed you earlier, where everything's happening at the open, and then there seems to be some buying throughout the day. The accumulation distribution indicator is an indicator that tells us this a little bit. I mean, if there's one indicator that you could follow that kind of looks at what I looked at, it would be the accumulation distribution. It's not exact, but if you finish in the top half of the candle, even if you went down from the prior day, if you finish in the top half of your day's trading range, then it's a positive from the accumulation distribution. So those days where we were gapping down but then finishing okay, those were actually treated, they are treated from an accumulation distribution standpoint as a positive. So like this day right here, where we had the big move down from about 124 to 111 or 112, we finished in the upper half of that candle body. So we actually saw the accumulation distribution going higher, for what it's worth. I mean, I do think that it is a little bit of a positive, but it's been happening now for so long. I don't know. I don't know if it continues, but it's just something that's worth, I think, mentioning. One last, let me check on that company for you, by the way, in terms of, they did beat bottom line. They had a loss of 25 cents. The market was expecting 28 cents. Stock down 13%. So that 15% or whatever it was, 15% that we went up yesterday, giving it right back today. And this, unfortunately, is the market that we've been in. You know, anything that we get one day, completely gone at the next day's open. The last one I wanted to mention in terms of earnings is GIS. This is General Mills. General Mills, big breakout here yesterday with huge volume. And today, let's get an update on it. They did beat 77 cents versus 75 cents, stock down 5%. But you can see this is one of the areas of the market because it's food related. People are stocking up, their sales are going up. And by the way, when it was going down, look at all these hollow candles and look at what the accumulation distribution was doing. So even when it was down more than 10%, accumulation distribution was rising. Now, in this case, we've gotten follow through to the upside. Many areas of the market we haven't. But again, it still points to the fact that in many cases, in most cases, a lot of the weakness that we're seeing is happening on the open. All right, let's go ahead. You know, there was a lot of upgrades, downgrades. Let me pull up one upgrade. This is Campbell Soup. So this is another company that, you know, is in that food space. So let's see what's going on there. Breakout in Campbell Soup. And we go over here and take a look. It was upgraded. Let's see. It's still down, but it's only down 1%. So it's not getting hit like the rest of the market. So again, there are pockets if you're looking for safer areas. You know, there are pockets out there. And actually one of the stock I was interested in looking at was actually Zoom, because we use Zoom and companies, you know, it's a technology company, hasn't really pulled back much off the lows, but a lot of companies are moving to this technology because you can work off site just like we're doing. I mean, everybody here is located everywhere around the world, all of you that are watching this, but I can present. And so a lot of companies who want to still remain in touch with employees that are now working remotely are all of a sudden going into companies and looking at companies like Zoom for solutions. And it's interesting, my daughter and I were talking about this earlier, and she said, you know, this is probably a lot of things that are coming out of this coronavirus are things that are probably going to change the way we do things going forward. I think there's going to be a lot more telecommuting going forward after this because companies are being forced into it. And so Zoom is a company that I find very interesting based on just the product that they offer and the environment that we're likely to have going forward. So we take a look and let's see what Zoom is doing in pre-market. Down 0.5%. So again, see, this is a company that because of the increased demand, because of the coronavirus, because of the impacts of the coronavirus, this is a company I think that's holding up extremely well. So there are candidates out there, you know, that have been able to weather the storm a lot better and for good fundamental reason. Whether or not it continues, obviously, is anyone's guess. But anyway, just wanted to point some of these along, to you as we run across them as well. All right, let's wrap up with the 3 you must see. What I did today is I just went into the scooters and I looked at the one that over the last week has made the largest scooter move. Now, you have to understand something about scooter moves. In order to make a big move, you have to have a low scooter to begin with. So I haven't looked at these charts yet, although I'm familiar with Raymond James. But these charts, I'm guessing, probably don't look very good because in order to move up 47 points to 75, it means we had to be down around 28 prior to this week, which meant that it probably wasn't a very good-looking chart. The other thing to consider is that now that it's moving up, remember, it's moving up relative to what everyone else. So it may still be going down, but maybe it's not going down as fast. But let's take a look at these charts. So I'm going to start with RGAF. Let's just pull the chart up, look at them quickly. Had a big day yesterday, probably going to struggle at the 20-day moving average. But you can see off of this move down. Look at the accumulation distribution, by the way, breaking out to a new high. Pretty interesting. Let's go back now and look at the biggest mover on the mid caps. This is an energy stock, Range Resources. Big move up. Even though we went to new lows in March, the accumulation distribution actually held those prior lows. And so there's been a lot of hollow candles, lots of volume with hollow candles. Looks to me like accumulation, but again, with everything so crazy in the market right now, you almost don't want to trust what you're seeing. And then the final one I wanted to mention, small caps. This Waiter Holdings, it doesn't even give me the sector and industry, but let's go ahead and just look at the chart. Huge amount. Well, my gosh, this thing was 25-cent stock. And it is moving up again today, up 47%. But these end usually, they can end pretty badly. So just be really careful on a stock like this. But anyhow, wanted to point out how you can go from stock charts, the big movers, the big scooter movers. And normally when you pull those up, by the way, let me go back here. Normally when you pull these up, they come up with, your intraday. So it would just show you what happened over the last week, or excuse me, last day. So I have to change this to get the last week. So anyway, let's go ahead and wrap it up. I do appreciate everybody stopping by. Again, I want to mention that our webinar from last night, it was recorded, but the recording is still processing. So, and it's out of our hands. I mean, literally, we're just waiting for it to process. So, and it might be, the technology glitch as a result of everybody coming into Zoom. I don't know, because they're probably being overwhelmed with folks signing up for their service. But as soon as it posts, we'll have it on the website. We'll let you know. Also, I'll be sending out the chart list from last night's charts that we talked about on Max Payne. I'll send you a link in the daily market report today. And then we'll also have that link up on the website so that you can have that there as well. And it should be under the chart lists later today. All right, let's go ahead and wrap up. Tomorrow I'll be back at Stock Charts TV. It may be a pre-recorded like Tuesdays was. I'm trying to work with them as best I can. They're pretty heavily hit. They're out in the Stock Charts is out in the Seattle area where the coronavirus is one of the worst hit. That's one of the worst hit areas in the country. So they're all working from home, trying to piece some things together. And also, as a result, we've got our shows, some of the shows there being pre-recorded and then broadcast during the normal time. But I'll be doing that at some point tomorrow. It's just a matter of whether it's pre-recorded, but it probably will be. Anyhow, everybody have a great day. I'll be back with Earnings Beats doing Trading Places Live next Monday. So mark your calendars. Hopefully we'll get a better market at some point, but we absolutely need to see a little bit more clarity. And right now we just don't have that, unfortunately. Take care out there, and be back tomorrow at Stock Charts. Happy trading.